Hello student, this is Dr. Athir Iqbal. Today we will discuss and solve an activity on cash conversion cycle. As we have discussed in previous lectures, that cash conversion cycle play a very important role in the business operation and recovery of cash. So you will see that how we will use different informations and understand that in how many days company is able to recover whatever cash they have already invested in their business operation. Just look at the question detail. There are two inventories is given. One is opening and the second one is ending. Purchases and sales of the entire year is already given. Receivables opening and ending both are given, as well as account payable opening and ending is given. It is possible that sometime your question is giving you only one inventory or one receivable or one payable. In that case, whatever information is given, you will assume it as ending inventory, ending receivable, and ending payable. But in case if both the informations are given, like inventory opening and ending both are given, in such a situation, we have to take averages in our entire calculation wherever you require average inventory or you require receivable or you require payable. So if I'm interested to calculate inventory period, to calculate inventory turnover days or inventory period, whatever name you're calling it, you need average inventory. You multiply by the 365 days of the year and you will divide by cost of goods sold. Now suppose question is giving you average inventory, then there is no issue. You can directly use that information. If question is not providing you average inventory information, then you will use this formula to calculate average inventory. You will take opening plus you will add ending and divide by 2. So average inventory we can easily calculate with the help of information like uh, in this you can see that opening is given 120, ending is given 75. We will add these two one and we will divide it by 2. So average inventory right now in our question is 97.5. If cost of goods sold is given, it's okay. If it is not given, then you can calculate cost of goods sold with the help of opening inventory, purchases and ending inventory. You are quite familiar. We have done a lot of time in our financial accounting courses as well as in costing courses. So opening purchases is already given in your question. 400 purchases is given, opening and ending both are given. So you will add and minus and you will get cost of goods sold 445. To calculate inventory turnover period, we will take average inventory, multiply by the 365 days and you will divide by cost of goods sold. So your final answer is coming 80 days. It means that in 80 days you are able to sell your stock whatever you already bought. In a similar practice, you can easily calculate receivable period. Again, you need average receivable, multiply by 365 and divide by annual sales. Average, as we did earlier, we will take opening and ending and divide by 2. So I'm showing you back that receivable opening and ending both are given. We will use this information and divide by 2. So average is coming 250. It is possible that opening and ending is not given in sequence, so it doesn't make any difference. Your actual work is simply to add these two and divide by 2. So average is 250 multiplied by 365 days as required by the formula and divide by annual sales, which is given in question, annual sales of 2000. So 46 days. This 46 days calculation is showing that in 46 days you are able to uh, collect receivable from your customers. Now the last part, account payable period. Again, you need average account payable multiplied by 365 and divided by cost of goods sold. We have already worked on cost of goods sold, so I'm not repeating here again. I'm simply taking the average payable, opening plus ending divided by 2. So the average payable, again showing you this information was given, opening and both ending are given. We will simply add it and divide by 2. So you will get 100. Of course, this asterisk sign is wrong here. It should be division sign. Once you get the average of 100, and you will take the final formula of average payable multiplied by 365 and divided by 445. 445 we already calculated here. It was cost of goods sold as we did earlier of 445. So I'm using this information as a cost of goods sold. So we will divide by cost of goods sold. So your answer is 82 days. It means in 82 days, you are actually paying to your suppliers. Once I have computed all the information, I will simply put it in the cash conversion cycle formula, in which I will take the receivable days, I will add inventory days in it, and I will minus payable days. So if we will add these two one and minus this one, so 44 days is showing the overall cash conversion cycle. This 44 days is indicating that on average, firm is able to recover cash in 44 days. Again, reminding you, as we did in the previous lectures, that now the firm will plan whether these 44 days is quite comfortable, they are happy with this recovery time or not. If they have to make any change in it, then they have to work on various segments. They can either reduce the receivable days, or they can further improve their inventory days, or they can further extend the supplier days. So they can take various decisions, and based off those decisions it is possible that their cash conversion cycle may decrease, and in some cases it might also increase, depending what outcomes are coming after the decisions they have taken in their meetings.